How would you react if you learned you could own a piece of a skyscraper for less than the cost of a pair of shoes? Right now, someone in your city is receiving monthly rent checks from a massive shopping center, and chances are they've never set foot inside the building. Imagine turning your pocket change into passive income, all from the comfort of your couch. The secret lies in REITs, or real estate investment trusts. REIT investing is surprisingly simple if you know what traps to avoid. Stick around because in the next few minutes you'll discover how to transform $100 into real estate ownership, demystify the rat maze, and potentially unlock a stream of income most people never realize is possible. Ready to build your portfolio like the pros without needing a millionaire's bankroll? Let's make something clear. REITs aren't some exotic Wall Street trick. They're designed for mainstream investors. Picture this. You walk into a grocery store, pass a luxury apartment, scroll through your favorite shopping site. All of these places might be owned by a REIT, and pieces of that ownership are bought and sold every day. If you've ever dreamed about owning property, building wealth, and collecting rent, all without loans or landlord headaches, REITs are one of the most powerful vehicles available. Hold up. How can something so simple be overlooked by so many? Maybe it sounds too good to be true, especially when real estate conjures images of down payments, cable installers, and 30-year mortgages. But what if you could skip all the paperwork and still get a slice of the returns? Stick with this because we're breaking down everything, from the foundation to the penthouse, giving you clarity, confidence, and a real plan to start. Here's the first mind blower. REITs are legally obligated to pay out at least 90% of taxable profits as dividends. Take a breath and let that sink in. While traditional companies may hoard their earnings, REITs operate under a strict rule. If the properties make money, the shareholders get paid. Real estate in a box? Almost. Let's reveal the playbook. First, what is a REIT, really? Imagine if a giant company pooled together funds from thousands of investors, used it to purchase income-generating properties, and then gave everyone a share of the profits. That's a REIT in one line. You're not just buying stocks, you're tapping into physical assets, hospitals, data centers, apartments, shopping malls, even timberlands. Now imagine the security guard at your local office tower unknowingly working for you indirectly. Here's a question. Why would a newcomer pick REITs over buying property directly? Consider the headaches: negotiating prices, signing contracts, hiring plumbers, navigating volatile markets, legal battles, and vacancies. With REITs, you get instant diversification, professional asset management, and liquid shares you can sell with a click. Your $100 could be earning a cut from thousands of tenants across the country without ever unclogging a toilet. Let's pull back the curtain further. That $100 could be spread across multiple properties, skyscrapers, warehouses, cell towers, because most REITs own dozens, sometimes hundreds of sites. If one building floods, another thrives. It's the polar opposite of buying a single rental home and sweating every repair bill. Want proof? Some REITs pay out dividends every quarter, some monthly, creating a rhythm of cash flow that feels much closer to rent collection than stock speculation. Now, not all REITs are alike, so let's walk into the REIT mall. What are you shopping for? There are equity REITs, which own and operate properties, think apartments, malls, hotels. Then there are mortgage REITs, which lend money to property owners and profit from the interest. This is more like being the bank. Hybrid REITs blend the two. Your choice shapes your income streams and risks. Feeling sophisticated? There are also specialties: data center REITs, healthcare REITs, infrastructure REITs, even timber and farmland REITs. Yes, you can own a piece of the forest just as easily as buying a stock. Here's a twist you won't see in most real estate discussions. REITs are traded on stock exchanges, just like Apple or Tesla. That means you benefit from transparency, strict regulations, daily pricing, and near-instant liquidity. No brokers, escrow agents, or weary realtors. Want in or out. Hit the button and you're done. Compare that with the average 6-month slog to sell a house. If you want flexibility, REITs are unmatched. Now, what about the flip side? Nothing in finance is pure upside. Here's what the wise investor watches for. REITs rely heavily on market conditions. If interest rates spike, property values can wobble, and so can rent payments. If the economy tanks, tenants struggle, and so do dividends. Management matters. A poorly run REIT can sink just as fast as a mismanaged apartment complex. And because REITs pay out most profits, they usually borrow to grow, exposing you to debt risks. The lesson? Pick your REITs like you'd pick a business partner. Here's one more curveball. Taxes. REIT dividends are typically taxed as ordinary income, not at the lower rates reserved for qualified stock dividends. But if you hold REITs in a tax-advantaged account like an IRA or 401k, you can sidestep much of that. Smart investors use this trick to maximize their net returns. So how do you wade into the REIT world with $100? The answer is as simple as opening a brokerage account. Most REIT shares are affordable, often less than $50 apiece. With fractional share investing, even pennies count. You might start by researching leaders, big names like Realty Income, Simon Property Group, or Public Storage, or choose REIT-focused ETFs, which bundle dozens of REITs for instant diversification. At this point, you might be wondering, how do you choose the right REIT? Look for signs of health. Consistent dividend payments, strong property portfolios, solid management teams, and growth in funds from operations, FFO. This last metric replaces earnings per share, giving you a real window into rent collected and expenses paid. Check the debt load, the tenant mix, and the geographic spread. The most resilient REITs survive downturns and thrive when markets rebound. Here's a real-world story. Picture Brad, a newcomer to investing. He puts $100 into an industrial REIT focused on logistics warehouses. Over time, that investment grows, not just from rising property values, but from regular dividends paid out like clockwork. Unlike buying a condo, Brad pays no property tax, does no repairs, and sells out in seconds. Meanwhile, his friend Sally pours $100,000 into a duplex, bankrolls new carpets, hunts for tenants, and still faces vacancy scares. Fast forward a year, Brad's portfolio is liquid and steady. Sally's investment is a roller coaster. This leads to the most crucial comparison: REITs versus direct real estate investing. On the one hand, that feeling of holding a deed, choosing paint colors, and screening tenants is tangible and rewarding. On the other, it's costly, time-consuming, and can be risky. REIT investors trade control for convenience, but often gain diversification, easier access to cash, and fewer sleepless nights. Direct owners can leverage mortgages and sweat equity, but suffer the volatility of local property markets. Let's break down the similarities and differences further. In direct ownership, you pick your assets, control all decisions, and can tap into rising home prices. You also shoulder 100% of the risk: repairs, lawsuits, water damage, market cycles. REIT investors have teams of experts managing portfolios worth billions, using sophisticated software and industry connections to maximize performance. You don't worry about broken boilers or tenant disputes. The REIT handles everything. Here's the shocker. Some REITs outpace physical real estate in long-term returns. Historically, REITs have averaged returns close to 10% annually, rivaling or beating private ownership, especially when counting dividends and growth. Of course, the same market swings that help can also hurt. REIT prices can fall with the broader stock market, sometimes for reasons having nothing to do with the underlying real estate. Now let's talk volatility. REITs tend to swing more than physical property. Stock prices move by the minute, influenced by headlines, global events, and investor sentiment. But what you lose in stability, you gain in flexibility. Need to cash out? REITs make it effortless. For physical property investors, selling involves inspectors, lawyers, and often a lot of patience. You're not just investing in buildings, you're investing in trends. Today's REIT landscape includes industrial giants powered by e-commerce, healthcare facilities riding demographic waves, tech-linked data center REITs, and renewable infrastructure REITs focused on the green energy revolution. You can tilt your portfolio based on predictions. If you expect logistics, healthcare, or tech real estate to boom, there's a REIT for that. Another strategic edge: portfolio integration. REITs offer exposure that's often distinct from the stock market or your bond holdings. During times of inflation, real estate can act as a hedge against rising prices, protecting your purchasing power. Smart investors allocate 5 to 15% of their portfolios to REITs, smoothing out bumps when stocks and bonds falter. Imagine this next scenario. Someone with a high-flying tech job, a mutual fund portfolio, and zero time for the headaches of physical property. For them, REITs are the perfect bridge. Real estate returns, no hands-on work, and assets managed by pros. On the flip side, a hands-on investor hungry for tax breaks and sweat equity might prefer the property ownership route. Still, every strategy has pitfalls. The biggest risk with REITs? Market overexuberance. Sometimes REIT shares are bid up to unsustainable levels, disconnected from the income the properties generate. Savvy investors wait for pullbacks, analyze the numbers, and avoid hype. The best entry points are often during market corrections, when prices disconnect from long-term fundamentals. Here's a toolkit you can use today. Pick your REIT after running a simple checklist. What are the properties? Where are they located? Who are the tenants? Big brands or unstable newcomers? How long are their leases? What's the credit profile of the REIT itself? Dig into annual reports and investor presentations. You don't need an MBA, just curiosity and Google. Let's talk fees. REITs charge for management, property upkeep, and expansion. Most listed REITs keep fees moderate, but private REITs, available only to accredited investors, sometimes charge more, lock up funds for years, and add layers of complexity. For newcomers, listed REITs are simplest, most transparent, and low cost. Another question that always crops up: how do REITs handle recessions? Just like any real estate, some sectors suffer, some thrive. During downturns, retail REITs might see sales fall, but healthcare and apartment REITs often remain steady. Diversification is your shield. Don't put all your eggs in one property type. One of the most misunderstood factors: leverage. REITs often borrow to purchase more assets, boosting returns but also increasing risk. Track the debt-to-equity ratio. A lower number means less risk, higher means more growth but higher volatility. Most strong REITs balance debt smartly, avoiding reckless expansion. Want to know a top strategy the pros use? Automatic reinvestment of REIT dividends. Instead of cashing out quarterly or monthly, opt into DRIP programs, dividend reinvestment plans, turning payouts into new shares. This can supercharge compounding over the years and turn small contributions into sizable accounts. Let's switch gears. What are the latest trends shaking up REIT investing? In recent years, technology-focused REITs, like those owning data centers and cell towers, have exploded alongside digital transformation. Pandemic shocks hit hotels and retail properties, but turbocharged industrial and warehouse REITs. ESG, environmental social governance criteria, mean investors now evaluate how green and sustainable their REIT portfolios are. Newcomers can use websites like Nareit or brokerage research tools to filter options based on yield, growth, risk, and social responsibility. Now, what about buying direct real estate through new platforms like crowdfunding? This lets you own slices of real buildings, but often lacks transparency and liquidity. Most platforms have lockups, higher fees, and less oversight. For maximum flexibility and regulatory clarity, listed REITs win hands down. Remember, no strategy fits everyone. People with deep market knowledge and renovation skills thrive in property ownership. Investors who value simplicity, liquidity, and diversification choose REITs. The key is knowing your strengths, risks, and goals. Picture yourself 1 year from now. You've started with $100, chosen 3 REITs, 1 apartment, 1 industrial, 1 healthcare. You see monthly or quarterly deposits land in your account. You track earnings, tweak investments, and expand your portfolio. Instead of worrying about burst pipes or slow tenants, you focus on growth, compounding, and strategic choices. Your risk is spread widely. Your time is free. Your account is liquid. Real estate, once exclusive and intimidating, is now open to you, and a whole new class of investors. REITs have democratized property ownership, delivering passive income, professional management, and portfolio flexibility. If you can buy a cup of coffee, you can own a piece of America's skyline. The next move is yours. Will you continue dreaming about real estate returns or join the millions quietly collecting passive income every month? With REITs, the path is open, the tools are at your fingertips, and the barriers have never been lower. Pull up your brokerage, run your research, and get started. For less than the cost of a few lattes, you can own a slice of the city. If you want true freedom, remember this final principle. The wealthiest investors in history built fortunes brick by brick, property by property. Today, REITs let you do the same. Scaled up, managed by experts, and accessible through your phone. No landlord drama, no repair bills, no locked up capital. Just a well-designed channel for ordinary people to step into the world of real estate investing $1 at a time. So turn that $100 into something extraordinary. Your journey starts now.
It's funny how people talk about money like it's some genius employee that magically multiplies the moment you hand it a paycheck. Truth is, when you first start investing, your money's more like an intern who keeps asking where the stapler is. It doesn't know what it's doing yet, and it definitely doesn't look like it's working for you. You save, you invest, you wait, and the results feel microscopic. You start wondering if everyone else has access to a different version of math. That slow burn, that frustratingly quiet stage where nothing seems to move, that's where most people give up, but that's also where the magic is hiding. See, compounding isn't fast food, it's slow cooking. It takes forever to smell good, but once it does, it feeds you for life. And the 8-4-3 rule is like a map that shows when things finally start to taste good. The idea is simple. If you start in your 20s, you've got roughly 8 decades ahead of you. In your 30s, you've got 4. In your 40s, about 3. The earlier you plant, the longer your tree gets to soak up sunlight. But that's the surface level. The deeper truth? Compounding doesn't reward effort immediately. It rewards endurance. Imagine someone named Liam. 23, fresh out of college, not rich, not poor, just trying to figure it out. He decides to invest $400 every month into a boring index fund. No timing, no gambling, no hot picks, just autopilot. At first, it feels like he's pouring money into a black hole. He checks after a year with nothing spectacular. 5 years later, still underwhelming. It's like lifting weights but not seeing muscle, but he keeps going. Because even though the numbers are small, something invisible is forming, momentum. Now fast forward 10 years, he's invested about 60 grand. His portfolio is around 75. Nothing to brag about at a party, but here's the thing. He's trained himself to invest without emotion. And that habit, that's worth more than any return. Meanwhile, his older cousin Ava starts investing at 45. She puts in $2,000 a month and thinks she'll catch up. But she won't, because she's missing what Liam gave his money. Time. Time is the multiplier nobody can buy back. The first decade is like the crawl phase. You're pushing a boulder uphill, barely seeing movement. Every contribution looks insignificant, but beneath that silence, interest is building muscle. And the weird part, you won't feel it working until suddenly it's all that's working. That's where Liam finds himself by his mid-30s. The dividends coming in are small but real. A few $100s that he didn't lift a finger for. He reinvests every bit, and those tiny checks start hiring workers. That's when compounding becomes self-aware. People love to talk about passive income, but this is what it actually looks like. Painfully slow, almost boring, then suddenly alive. And Liam raises his contribution to $800 a month, not because he's trying to beat the market, he's just giving more oxygen to something that's already growing. His contributions after 20 years sit around $156,000. His portfolio is nearing $400,000. Half of that didn't come from him, it came from growth feeding on itself. And most people never make it to this point because they get bored during the crawl. They jump from trend to trend, crypto 1 year, gold the next. They mistake movement for progress. Liam does the opposite. He stays still, the market drops, headlines scream, everyone's panicking, and he just shrugs, sets another auto transfer, and walks away. That's the hidden skill of compounding. Emotional silence. By his late 30s, his dividends alone are roughly $1,000 a month, a quiet second income that doesn't demand meetings, bosses, or schedules. It's not glamorous, but it's freedom starting to whisper. Here's the irony. Once compounding starts working, it doesn't need you anymore. That's when you realize the biggest risk wasn't losing money. It was quitting before the curve bent upward. Liam's story doesn't suddenly turn into fireworks. There's no Lamborghini, no "I retired at 35." What happens is better, just stability. He stops worrying about bills, he starts focusing on compounding in other ways, learning, building side projects, growing skills. He understands now that compounding doesn't just apply to investments, it applies to everything. Consistency in any direction eventually turns invisible effort into visible results. By 40, he's earning more, saving more, investing more, but none of it feels like discipline anymore. It's automatic. His money and mindset are compounding in sync. And that's when the 8-4-3 rule reveals its deeper meaning. The 8 isn't just about years, and it's about giving yourself enough time for the boring to become powerful, because that's what compounding really is, boring power. Everyone wants fast results, but fast doesn't last. Slow builds roots. Those roots keep your financial tree standing when storms hit. By his 40s, something strange starts happening. He stops feeling like he's building wealth and starts feeling like wealth is quietly building him. The portfolio once treated like a fragile experiment now feels alive, breathing on its own. He doesn't need to chase returns or check charts anymore. What used to feel like a desert of slow progress has turned into a garden that keeps growing. The dividends that once trickled in are now rolling in faster than he could ever save by hand. Each one instantly buys more shares, and those shares start earning their own dividends, a self-replicating loop that never sleeps. The same $400 habit that once felt pointless transformed into a financial conveyor belt. Smooth, steady, impossible to stop. That's the moment when compounding changes personality. It stops being shy, it starts showing off. The snowball effect, it's real, but it's not magic, it's math plus patience. Every share creates more shares through reinvested dividends. It's like he hired an army of invisible workers who never sleep, never eat, never take vacations. What used to feel like drops in a bucket now feels like waves in an ocean. By year 25, his total investments crossed $300,000, but his portfolio, over $1 million. 3/4 didn't come from what he saved. It came from what he kept invested. That's the quiet revenge of time. This is where compounding stops being numbers and starts feeling personal. For years, it felt like a grind, but now every uptick feels like a quiet thank you from his past self. It's no longer a sacrifice. It's proof that patience wasn't weakness. The growth curve keeps steepening. Every month accelerates. Every dividend is larger. His money finally found its rhythm and now it's dancing on its own. He doesn't flinch during market crashes anymore. He looks forward to them. The system works better when fed cheap prices. He used to see red charts as threats. Now he sees them as clearance sales. That's when, you've evolved from an investor to an owner. He's not chasing hype. He's letting time compound quietly while he lives his life. Meanwhile, the people who once said investing was too slow are back at square one, chasing trends, restarting. The same people who laughed when he bought index funds are now asking how he did it. And all he did was nothing for a long time. That's the paradox of compounding. The less you try to force it, the better it works. By his late 40s, passive income from his portfolio covers most expenses: rent, utilities, groceries, all handled by dividends from decisions made 20 years ago. The kid who once thought $400 wouldn't matter now has an investment account that pays more than his old salary, but it's not luck. It's compounding. The most boring, most powerful wealth engine ever invented. And the best part? It doesn't just grow money, it rewires how you think about everything. When you experience compounding firsthand, you start noticing it everywhere. Relationships compound, skills compound, habits compound. You might not see the reward today, but 5 years from now, tiny effort you made daily will be why something massive stands in your life. That's why wealth isn't built by people who chase results. It's built by people who chase repetition. Liam applies this mindset to side projects. He starts a faceless YouTube channel about finance, no fancy setup, just simple content uploaded week after week. The first few months feel like déjà vu. Nothing happens. But this time he knows better than to quit when it's quiet. He keeps showing up, then like compounding itself, something shifts. One video picks up traction, then another. 2 years later, that tiny experiment is making him $1,000 a month. Not from luck, but from boring consistency. Everything worth having grows the same way, quietly then all at once. He doesn't spend it, he invests it, and that's how compounding feeds itself. One engine fueling another. When the market drops 10%, he doesn't panic. When his job feels uncertain, he doesn't spiral. There's a system quietly working 24/7, and it's his portfolio now. He's built a second version of himself, one that earns money even while he sleeps. That's what the 8-4-3 rule represents. Not 3 random numbers, but 3 timelines of momentum. 8 decades ahead if you start early, 4 decades if you start later, 3 decades if you start midlife. It's never too late, but the earlier you begin, the more outrageous the compounding looks at the end. The hardest part isn't finding the right fund or timing the market. It's surviving your own impatience. The first 10 years feel pointless, the second feel promising, the third feel unfair, and in the best way, Liam learned the truth most never accept. Wealth isn't a finish line. It's a rhythm. You don't reach it, you sock, you live in it. He no longer tracks net worth obsessively, he tracks peace of mind. And peace, like money, compounds too. That's the silent reward of staying consistent. You don't just grow rich, you grow calm. By his 50s, his portfolio is worth around $2.5 million. He's contributed maybe $750,000 total. The rest, almost $2 million, wasn't earned, it was grown. His money learned how to clone itself. Those small dividends are now louder than his paychecks. They arrive whether he's working, traveling, or doing absolutely nothing. That's what financial freedom feels like, not fireworks, not quitting on camera, but quiet control. The ability to say no to anything misaligned with your peace. By 60, his passive income hovers around $75,000 a year, more than $6,000 a month, enough to live anywhere, enough to never worry about bills. But it's not just the money that's grown, it's the calm. And here's the twist. You don't have to wait until your 60s. Freedom sneaks in quietly. It's the first time your investments pay for dinner, the first time your dividends cover a bill. Those mini freedoms stack until one day you wake up and realize you don't need to trade your hours anymore. That's the most underrated part of compounding. It multiplies your choices. When you have money working for you, you decide what kind of life you want. You stop asking for raises and start asking for time. Liam spends mornings walking his dog, afternoons mentoring younger investors, evenings cooking with his partner. Nothing flashy, just slow, intentional living. The kind money can't buy but can quietly build. If only he could tell his younger self one thing. Keep going. You're not just building wealth, you're building momentum. That's the hardest part for anyone starting out, trusting growth they can't see. But every great thing compounds: muscles, skills, relationships, money. Small, repeated actions that feel invisible eventually become impossible to ignore. That's what makes the 8-4-3 rule powerful. It's not a formula, it's a philosophy. 8 decades of potential if you start early, 4 if you start later, 3 if you start midlife. In every version, you win, as long as you stay. Because compounding doesn't care about your age, it only cares about your consistency. Most people never get to the exponential part because they quit during the invisible part, but make peace with the silence and the noise will come later. And it'll sound like freedom. And so if you're thinking, I wish I started earlier, stop. That's just another excuse. The best time was years ago. The second best time is right now. You don't need to understand everything. You don't need thousands to begin. You need a starting line and courage to cross it. Automate your first investment, even if it's $50, even if it feels like nothing, because one day that nothing will turn into the most powerful something you've ever built. And if you want to speed it up, build extra income streams. Start something that feeds your investments. A channel, a side hustle, anything that compounds your cash flow. You don't need to show your face. You just need to show up. That's how compounding multiplies itself. One system feeding another, momentum looping endlessly. Do one thing today. Don't just watch this video, act on it. Start small, automate it, forget it, and let time handle the rest. And when it gets boring, perfect. That means it's working, because compounding always feels slow, right until it doesn't. And when it finally takes off, it doesn't just change your bank account, it changes your life.
If someone told you that a handful of ETFs could pay you every single month, enough to cover your rent, your bills, even your salary, you probably think it's too good to be true. But what if it isn't? What if there really are funds that generate steady monthly cash flow without needing you to pick stocks, time markets, or spend your life chasing the next big thing? Because today, we're diving deep into the world of income ETFs, the kind that pay real consistent money while you sleep. And yes, some investors out there are earning more from these 7 ETFs than they ever did from their 9-to-5 jobs. It all starts with a mindset shift. Traditional investing teaches you to think in terms of net worth, build a big portfolio, and one day, maybe decades from now, sell small pieces of it to live on. But that strategy depends on market timing, emotion, and luck. The income investing approach flips that idea completely. Instead of selling shares, you live off the cash flow, dividends, distributions, and option premiums that arrive every single month. Your portfolio becomes a paycheck machine. The first ETF that made this concept mainstream is JEPI, the JP Morgan Equity Premium Income ETF. JEPI is a beast. It holds a diversified basket of U.S. blue chip stocks, mainly S&P 500 names, and then sells covered calls on them to generate income. The result? A monthly yield that hovers around 8% to 10% paid out like clockwork. That means if you had a $100,000 investment, you could expect about $700 to $900 every month in distributions. It's not hype, it's math. And because JEPI focuses on high-quality companies and actively manages its call options, the risk-adjusted performance has been surprisingly strong even during volatile years like 2022. Right next to it is GPQ, JEPI's tech-focused cousin. This ETF targets the NASDAQ 100 instead of the S&P 500, using the same covered call strategy but with more exposure to big tech. Apple, Microsoft, Amazon, and Nvidia. That means higher growth potential but also a bit more volatility. The yield, around 10% to 11%. Many investors combine JEPI and JEPIQ for balanced exposure. JEPI provides stability, while JEPQ brings in the tech income punch. Together, they create one of the most efficient monthly income engines on the market. But let's say you want even higher yield and the kind that really replaces a paycheck. That's where QYLD, RYLD, and XYLD come in, the Global X Yield Trio. These ETFs are the purest form of covered call income plays, each targeting a different index. QYLD covers the NASDAQ 100, RYLD covers the Russell 2000, small caps, and XYLD covers the S&P 500. The yields can range from 11% to 13%, sometimes even more depending on market conditions. The trade-off? Limited upside growth because covered calls cap your capital appreciation. But for investors focused on steady income, not speculation, these ETFs can feel like owning a self-funding paycheck. For example, if you invested $300,000 spread evenly across JEPI, GPQ, and QYLD, you could expect roughly $2,500 to $3,000 in monthly income right now. That's before any dividend reinvestment or compounding. For many people, that's more than their rent or even a part-time salary. Now let's talk about 2 lesser-known but powerful additions to the income mix: SCHD and DVY. These aren't covered call funds, they're dividend growth ETFs, which means they focus on owning companies that consistently pay and increase their dividends year after year. SCHD, for instance, tracks the Dow Jones U.S. Dividend 100 Index, names like PepsiCo, Verizon, Texas Instruments, and Home Depot. It yields around 3.5%, but its growth in dividends is the real secret. Over the past decade, SCHD has increased its distribution almost every single year. It's the ETF that quietly gets better with age. DVY, or the iShares Select Dividend ETF, is another cornerstone. It focuses on U.S. companies with a long history of paying stable dividends, mostly in utilities, energy, and industrial sectors. The yield is roughly 3.7%, but like SCHD, it offers consistent tax-efficient income, perfect for those who want reliability without the complexity of covered call strategies. And finally, there's HDV, the iShares Core High Dividend ETF. Think of it as a dividend-paying fortress, packed with blue-chip names like ExxonMobil, Johnson & Johnson, and Coca-Cola. It's built to survive bear markets, recessions, and everything in between. Yields hover around 4%, and the price stability gives investors peace of mind. Now, if you add all 7, JEPI, JEPQ, QYLD, RYLD, XYLD, SCHD, and HDV, you can build a portfolio that delivers consistent income across all market environments. The covered call ETFs provide high yield and monthly cash flow, while the dividend growth ETFs give you long-term stability and rising payouts. It's a beautiful balance of offense and defense, monthly income now and growth later. Let's break down what kind of capital you'd need to actually replace your income. Say your goal is $4,000 a month, and that's $48,000 per year. Using an average yield of 8%, you'd need a portfolio of around $600,000. If your target is $3,000 a month, that's about $450,000. It sounds big, but here's the reality. If you invest $2,000 a month at an 8% total return, you could reach $450,000 in just about 12 years. That's within reach for many people. Even better, if you start with $100,000 and invest $1,500 monthly, you could get there in 10 years. Add consistent reinvestment of dividends, and that timeline shortens even more. The key isn't perfection, it's persistence. Now, it's important to talk about risk, and because income doesn't come free. Covered call ETFs like QYLD and GEPQ are known for their high yields, but they sacrifice upside growth since selling call options caps your potential gains. That's fine for income-focused investors, but not ideal for those seeking explosive long-term compounding. The best solution is blending, using growth-oriented dividend ETFs like SCHD or HDV alongside the high-yield covered call funds to smooth volatility and maintain total return potential. Also, remember that covered call income is taxed differently. Most of it is treated as short-term capital gains, which can be taxed at higher rates than qualified dividends. That's why many investors prefer holding these ETFs in tax-advantaged accounts like IRAs or Roth IRAs. Dividend growth ETFs, on the other hand, are generally more tax efficient since their payouts often qualify for lower tax rates. Structuring where you hold each ETF can make a big difference over time. Let's walk through an example of a balanced, income-optimized portfolio targeting $3,000 per month. 25% JEPI for core stability and yield, 20% JEPQ for tech-driven income, 15% QYLD for extra monthly cash flow, 10% RYLD and 10% XYLD for diversification and global yield exposure, 10% SCHD for long-term dividend growth, 10% HDV for defensive stability. At roughly 8% blended yield, that mix would produce around $2,900 to $3,100 per month on a $450,000 portfolio. The beauty? You'd receive those distributions monthly, meaning your portfolio becomes a replacement paycheck, not a savings account you have to deplete. But here's the big secret. You don't need to hit the goal all at once. Even partial income changes your life. Imagine covering just your groceries or your rent through dividends. Suddenly, your job stress feels lighter. You gain breathing room, and that's the start of real freedom. Over time, you can reinvest any surplus income until your distributions match or exceed your expenses. It's a self-reinforcing loop. Income generates more shares, which generate more income, until the snowball becomes unstoppable. This is what wealthy investors understand instinctively. It's not about getting rich quick. It's about creating a system that pays you forever. The market may rise and fall, but the cash flow never stops. And once your investments cover your life expenses, everything else you earn becomes optional. Of course, diversification matters. You don't want your entire income relying on a single strategy. Covered calls work beautifully in sideways markets, but can lag in strong bull runs. Dividend growth ETFs, on the other hand, thrive during growth periods. Together, they smooth out the ride, allowing you to collect consistent income in any environment. Another key piece of this puzzle is mindset. Income investing is slow, steady, and sometimes boring, and that's exactly why it works. The goal isn't excitement, it's stability. The people who truly reach financial freedom are the ones who automate contributions, reinvest diligently, and let time do the compounding. And let's not overlook taxes, healthcare, and emergency planning, essential parts of living off dividends. Ideally, you'd want at least 6 months of expenses in cash, so you're never forced to sell during downturns. Health insurance and predictable budgeting become crucial when your primary income is investment-driven. But the flexibility you gain, being able to work because you want to, not because you have to, makes it all worth it. Now imagine what happens 5, 10, or 20 years from now. You've built a dividend machine that spins off cash flow every month. Your JEPI and JEPQ distributions arrive like clockwork. SCHD's dividends have doubled, and your portfolio is now worth more than when you started, even after years of withdrawals. That's the power of compounding income layered over growth. And the moment it clicks, when you realize your portfolio has officially replaced your job's paycheck, it feels surreal. you start to understand what financial freedom truly means. It's not just about quitting your job, it's about owning your time. Because every dollar of dividend income is a tiny piece of your life returned to you. It's one more hour you don't have to trade for a paycheck, one more day spent on your own terms. That's what these ETFs represent, not just investments, but freedom engines. And here's the truth. You don't have to be a financial genius to make this work. You don't need to outsmart Wall Street or predict the next crash. You just need consistency, discipline, and a belief in time-tested principles. Every month, your ETFs are out there working for you, collecting dividends, selling calls, generating yield, all while you live your life. It's quiet, it's predictable, and it's powerful. So when people ask, can you really live off ETFs? The answer is yes. If you plan it, automate it, and stick to it, absolutely yes. The 7 ETFs, JEPI, JEPKI, QYLD, RYLD, XYLD, SCHD, and HDV can become the financial backbone of your life. They can give you what most jobs never will, income that doesn't depend on your time. If you're 25, maybe you want total return and compounding. But if you're 45, building a second stream of monthly income, that trade-off is not just acceptable, it's brilliant. To see how it plays out over time, let's run a few numbers. Suppose you invest $100,000 into a basket split between JEPI, JEPQ, and QYLD, averaging a blended yield of about 10%. That's roughly $10,000 per year or $833 per month before taxes. Now add consistent monthly investments, say $1,000 each month, with dividends reinvested and assuming an 8% total return, yield plus modest price growth, your portfolio could surpass $500,000 in about 13 years. At that point, if you decide to stop reinvesting and start drawing the income, that same 10% yield would throw off $50,000 a year, more than $4,000 per month. That's the power of steady contributions meeting compounding cash flow. Now imagine taking that same strategy but diversifying across risk profiles. JEPI and JEPIQ provide a balance between growth exposure and steady distributions. QYLD, which sells calls on the NASDAQ 100, is a heavier yield play. It can pay over 12%, though that's partly a return of premium. Some investors combine them in ratios like 40% JEPI, 30% JEPQ, 30% QYLD for a blend of consistency, yield, and tech exposure. Others prefer 50% JEPI for its defensive quality, then split the rest between RILD, covering the Russell 2000, and XYLD, covering the S&P 500. By mixing across indexes, you avoid being tied to the performance of just one sector. And while each fund's payout fluctuates, the overall income line stays surprisingly stable. Taxes, of course, are the silent factor many forget. Covered call ETFs often generate distributions that are a mix of qualified dividends, ordinary income, and return of capital. That means you might not pay a flat 15% rate as you would with traditional stock dividends. The best way to handle this? Hold them in tax-advantaged accounts whenever possible, like an IRA or Roth IRA. In a Roth, all those monthly payouts grow and distribute tax-free. If you're building toward financial independence, that difference can be massive, tens of thousands saved over decades. But even in a taxable account with smart planning and offsetting deductions, your effective tax rate on this income can be lower than most people assume. What's fascinating is how many ordinary people are using this approach, not to get rich quick, but to buy time. There's a quiet community online, teachers, engineers, retirees, even students, who track their monthly payouts like others track salaries. They post screenshots, $423 this month, $441 next month, $450 the month after. They're not millionaires, but they're slowly replacing hours worked with hours owned. Some even call it dividend time freedom. You might not quit your job tomorrow, but you could reduce your hours or choose work you actually enjoy because your bills are partly covered by a portfolio you built yourself. Now let's get practical. Suppose your goal is to replace $3,000 a month in take-home pay. At an average 9% yield, you'd need roughly $400,000 invested. That might sound intimidating, but break it down. Invest $2,000 per month, compound at 8% total return, and you'll reach that mark in about 11 to 12 years. If you can push $2,500 a month, it drops closer to 9 years. And if you're starting with a $50,000 base, even faster. The math isn't magic, it's just consistency. Every dollar reinvested buys you more future income. Every month you stay invested shortens the distance to freedom. And of course, diversification matters even among dividend ETFs. JEPI's portfolio leans heavily into large cap value names, Johnson & Johnson, Coca-Cola, ExxonMobil, PepsiCo, companies that pay and stay. JEPIQ adds tech exposure, Apple, Microsoft, Alphabet, but with the safety net of option premiums. Meanwhile, QYLD is more income aggressive, generating high yield by selling calls monthly, but at the expense of growth. The art is in balancing these pieces based on your tolerance for volatility and your need for cash flow. For many, a 40-30-30 split gives a nice equilibrium, steady dividends, modest growth, and limited drawdown risk. Let's take it one step further and talk about sustainability. What happens in a deep bear market? During 2020's pandemic crash, JEPI wasn't yet trading, but similar funds saw payouts dip slightly, yet far less than the collapse of stock prices. Why? Because the options premiums actually rise when volatility spikes. That means these funds can sometimes maintain or even boost income when markets tumble. Your portfolio might be down 10 to 15%, but your income remains largely intact. That's precisely the stability retirees crave, and why many now blend these ETFs with dividend aristocrat funds like VIG or SCHD for extra resilience. Now, risk isn't zero. Covered call strategies underperform in explosive bull runs. If markets rally 20% in a year, your upside may be limited to 8 to 10%. But that's not a bug, it's a feature. Because in most real-world years, markets aren't exploding, they're meandering. The steady drip of cash flow smooths out those unpredictable cycles. It's like choosing a reliable salary instead of an unpredictable commission check. You might not hit the jackpot, but you also won't face sleepless nights wondering if you can pay rent next month. For those serious about building income, tracking tools like Track Your Dividends or Portfolio Visualizer can show your expected monthly payout and simulate growth under different scenarios. Watch your income snowball grow each quarter. It's immensely motivating because you start to see the future, not in vague retirement years, but in tangible calendar-based paydays. You stop thinking in terms of net worth and start thinking in monthly income units. A $500,000 account paying 9% doesn't just represent $500,000, it represents $45,000 per year of working optional cash flow. Suddenly, money becomes less about accumulation and more about autonomy. Now let's zoom out. Why do these ETFs even exist? Because investors demanded an alternative to the growth at all costs culture of the last 2 decades. After multiple boom and bust cycles, people realized that realizing profits on paper doesn't pay the bills. Income does. Vanguard's Jack Bogle once said, "Don't look for the needle, buy the haystack." These ETFs take that principle and add a paycheck. Instead of selling shares to live, you live off what your shares generate. It's a subtle but profound psychological shift, from consumer of markets to owner of cash-flowing assets. Imagine waking up on the first of every month, checking your brokerage app and seeing dividends automatically deposited. No boss, no commute, no clients, just your portfolio doing its job. That's not fantasy, it's math multiplied by patience. Even starting late, at age 40 or 45, the runway is long enough. Time and reinvestment remain the twin engines of freedom. And there's a mental benefit too. When you're living off dividends, you stop reacting to daily market noise. A 2% market dip doesn't scare you if your monthly income is unchanged. You shift from price anxiety to income serenity. It's the difference between constantly checking Zillow for your home's value versus collecting steady rent from tenants. One is speculation, the other is ownership. Of course, the ultimate test is sustainability through real recessions. Historical backtests show that even during the 2008 financial crisis, similar income strategies recovered within a few years thanks to steady distributions. In contrast, purely growth-focused portfolios often required selling assets at a loss to generate cash flow. Here, patience literally pays. The investor who kept reinvesting dividends through downturns ended up far wealthier than the one who panicked and sold. For younger investors, combining monthly income ETFs with growth ETFs like VTI or SCHD creates a powerful dual engine, income plus appreciation. You can start small, maybe $500 in JEPI, $500 in VTI, and let it grow naturally. By the time you hit your 30s or 40s, that small position could be spitting out hundreds per month. The earlier you start, the less you need to contribute later. And if you want to go one step further into mastery, track your yield on cost. The effective yield based on your original investment. If you bought JEPI at $50 and it now pays $5 per year, that's a 10% yield on cost. But if years of reinvestment reduce your average cost basis to $40, that's actually a 12.5% yield on cost. It's not just the nominal yield that matters, but how efficiently your money is working for you over time. So maybe you start this month, one ETF, one step, one share at a time. You don't need to time the market, you just need to spend time in it. The math takes care of the rest. Reinvest, stay disciplined, and let the monthly deposits become your future salary. In a world obsessed with instant gratification, the patient investor who builds predictable income is the one who truly wins. And that's the beauty of it. These ETFs, JEPI, GPQ, QYLD, and their cousins aren't glamorous. They won't make headlines on CNBC or Reddit, but they work month after month, year after year, because true wealth isn't about how much you make, it's about how much keeps showing up even when you don't have to. And that's exactly what this strategy delivers. So the next time someone asks how you make your money, you can just smile and say, I get.
Everyone from finance bloggers to your cousin treats VUO like the sacred ETF. Low cost, simple, track the S&P 500, boom, done. Just because something is popular doesn't mean it's the best option forever. Remember when BlackBerry was the king of phones? VUO is a fantastic ETF, but if you're serious about investing, is it still the only game in town? Spoiler alert, there are actually better options. Why is VUO so loved? 3 reasons. Low expense ratio of 0.03%. It mirrors the S&P 500. And it's from Vanguard, a trusted name. The S&P 500 isn't the same as it was 20 years ago. It's top-heavy, dominated by a few mega-cap tech stocks. Buying VOO means you're mostly betting on just those 6 giants. If they stumble, your diversified ETF looks less safe. There are ETFs designed to reduce concentration risk, tilt toward quality, or blend in some bonds for stability. You don't have to be stuck with VOO. Invesco S&P 500 Equal Weight ETF, RSP, offers an equal slice of the pie for all 500 companies, giving a voice to those that usually go unheard. Imagine a dinner party where 5 people dominate the conversation. RSP ensures all 500 stocks get equal time instead of just the biggest companies. RSP shines in markets where smaller and mid-sized companies are thriving. Equal weighting outperformed after the dot-com crash. It spreads the love across all companies, reducing dependence on the giants. It's like betting on the whole team. Where it stumbles is when mega-cap tech is booming. RSP lags as it trims runaway winners. It also charges more, about 0.20% compared to VOO's 0.03%. Not a deal breaker, but a consideration. Investors benefit who prefer not putting all their eggs in the mega-cap basket. True diversification is key. If you enjoy watching big tech carry your portfolio, VOO may be more rewarding. It's a choice of strategy. This one is all about picking the good kids in the market. Not the loudest, not the flashiest, but the companies with solid fundamentals. VFQY screens for strong balance sheets, consistent profitability, and reliable earnings. It tries to separate the durable businesses from the ones skating on hype or drowning in debt. Where does VFQY shine? In downturns. Quality companies tend to lose less ground when markets tank. Think of it as the sturdy Toyota that keeps running when everyone else's flashy sports car breaks down on the highway. Avoiding catastrophic losses can actually leave you further ahead than chasing risky growth that eventually collapses. VFQY looks downright boring compared to euphoric bull markets where investors pile into meme stocks or SPACs. It deliberately avoids fragile, speculative companies. While your neighbor shows off their doubling portfolio, VFQY stays grounded, focusing on sustainability over fleeting hype. It's built for endurance, not excitement. VFQY may miss out on some fireworks, but it filters out companies likely to fail, betting that fundamentals will triumph in the long run. Who benefits? Those averse to big drawdowns, seeking smoother sailing. Like a steady paycheck, VFQY is reliable, not flashy. For those desiring raw upside and who can tolerate volatility, VOO's broader method feels thrilling. VFQY emphasizes financial strength over sheer size. Maybe you're thinking, all right, I like the S&P 500, but why stop there? Why not own every investable US company? That's VTI. It doesn't stop at the 500 biggest names. It scoops up mid-caps and small caps too, giving you exposure to around 4,000 stocks. Where does VTI shine? When small and mid-caps catch fire. These scrappy underdogs can grow faster than the giants. Over the long haul, mixing them in gives your portfolio a little extra juice. It feels more like a complete snapshot of the US economy. Where does it stumble? When the economy slows or interest rates rise, small caps usually take the first punch. Most of your returns will still come from the top 500 anyway. The Apples and Microsofts of the world still drive the bus. Investors looking for a comprehensive view of US growth will find value in VTI, as it showcases today's smaller innovators for those who believe in their future. For those preferring simplicity and wanting to stick with well-established players, VOO is the ideal choice. Simpler, easier to track, and a bit less bumpy. Balanced ETFs combine stocks and bonds in various ratios, like 60-40 or 70-30. They provide a smoother investment ride, cushioning against volatility. In downturns, bonds stabilize your portfolio when stocks fall. This balance helps maintain value and can ease investors' emotional stress during market chaos. Ultimately, sometimes the best investment skill is avoiding emotional mistakes. A balanced ETF can provide the cushion needed to stay invested during tough times. In roaring bull markets, bonds become an anchor dragging behind you. You'll watch others brag about their 20% returns while your portfolio stings at 14%. Balanced funds often underperform pure stock funds like VOO, especially in today's low-yield world. Who benefits? Investors who know themselves. If a portfolio drop would make you panic, a balanced ETF might be the smarter choice. If you can see a crash as a discount season instead of a disaster, VOO's all-stock approach may lead to better long-term gains. The key isn't which fund is better, but which one matches your personality. Balance is more about psychology than math. Think of factor and specialty ETFs as the toppings bar of investing. Load up with your favorite traits like dividends, low volatility, or sectors. These funds tilt toward very specific traits. If you believe a certain style will shine, these ETFs let you lean into it without picking individual stocks. Low volatility ETFs, for example, can feel like a seatbelt in a storm. Dividend ETFs are another favorite. They keep paying you month after month, even when prices are stuck. Momentum ETFs chase what's already working, stocks on hot streaks. They can deliver explosive returns. Specialty ETFs allow investors to make targeted bets on themes like clean energy or cybersecurity. The same traits that make them powerful also make them vulnerable. Factors fall in and out of favor, sometimes for years at a time. Value ETFs lagged growth stocks for nearly a decade while tech companies soared. Dividend ETFs can feel sluggish during growth. Momentum funds? They're exciting until the music stops. Trends reverse quickly and can feel like a falling knife. Specialty ETFs magnify opportunity but also risk. A sector like clean energy can soar during a government push, then collapse. Investors who want customization benefit most. Factor and specialty ETFs allow aligning investments with personal beliefs. They are not set it and forget it tools. Like a garden, they need watering and pruning for optimal performance. In contrast, broad funds like VU are autopilot, simply riding the market as a whole. Done right, factor and specialty ETFs can be a useful tool. Done poorly, they may distract from larger goals. So the real question isn't whether they're better than VU. It's whether you want to spice things up or keep your plate simple. RSP spreads the risk across all 500 companies instead of letting the giants dominate. VFQY filters for quality so you're holding sturdier businesses. VTI goes broader, scooping up the entire market. Balanced ETFs mix in bonds to calm your nerves. Specialty ETFs let you tilt towards styles or sectors you care about. Each one solves a problem that VOO doesn't. RSP tackles concentration risk. VFQY tackles stability. VOO isn't broken. It's just not the only option anymore. The ETF world has exploded with choices. Whether you want more balance, quality, breadth, or peace of mind, there's an ETF designed for that. So the next time someone says, just buy VOO and forget it, remember, you've got options. If this breakdown gave you a new perspective on ETFs, hit that like button, drop a comment, and subscribe.